In this video segment of the Wall Street Academy, we're going to be discussing risk management, why it's so vital as far as your success as a trader, what kind of damage it can do, and what I hope to accomplish by making this video is for you to understand at the end of this video that risk management and trading is a discipline. It's a discipline that if you understand it and you take it seriously, you can have all the success you desire as a trader. However, if you take risk management and you abuse it, your success as a trader is going to be very limited. It's going to be very hindered. So throughout this video, follow what I'm describing in the scenarios and the situations we're going to go through. So I hope, again, by the end of this video, you have a little bit better idea as far as what kind of damage risk management can do as a trader for you. And if you understand it, what kind of success you can have as a trader. So let's go ahead and begin. So I'm going to go ahead and use scenario 1 with 1 to 1,000 leverage. We're going to be using a $1,000 account. And we're going to go ahead and assume that you're using a 10% risk management strategy. What this means, and again, I'm going to go ahead and use approximate numbers. They may not be exact. What this means is that you can allot $100, which is 10% of 1,000, towards lot size. Now, when trading using 1 to 1,000 leverage, not taking in precious metals into account like silver and gold, they are a little bit more expensive. So we're going to go ahead and use some of the majors such as Euro, USD, and such. Those pairs cost about $100 for a standard lot. So you would be able to, in this situation, purchase one lot. Now, what I do is every trade that I enter, I look to make a minimum of 30 pips. But I also have a 30 pip as far as how much I'm willing to lose. I make that number 30 pips. Now, my trading strategies vary. Overall, I trade with a success rate of about 80% or such, depending if I'm using some new strategies that I'm testing out or I just stick to my strategy that works. For this scenario, we're going to go ahead and use a trader with a 70% win ratio. Which means that out of 10 trades you take, you win 7 trades. So in this scenario, with one lot size, you are gaining or losing $1 per pip. And again, this is gonna it's gonna be dependent upon factors such as how good are you at entries in the market, how well are you at trading, and your skill level. If you're talking about someone like Quill and Black, he's absolutely phenomenal with entries. So he can go ahead and jump right into the market and pretty much just be immediately in profit. So we're going to go ahead and use this. One lot this trader is using with a 70% risk management, or excuse me, a 70% win ratio, means they're winning 7 out of 10 trades. they're using one standard lot and a 10% risk management, which means, again, they're losing or making $10 per pip. So we're going to go ahead and take into account the worst case scenario, which if this trader is winning 70% of their trades, that means that they're losing 30%. So the worst case scenario is that they lose their first 3 trades before winning their next 7. In this instance right here, if they are losing 3 trades and they're losing 30 pips, that means that they're losing $300 per trade. So their first 3 trades, if they were to lose their first 3 trades, that would total to a little over $900. And their account balance wouldn't even be able to sustain trading a lot. So in this instance right here, you now understand that worst case scenario, again, it can happen, using a 10% risk management, it's too high. We're going to go ahead and delete this. We're still going to use a 1 to 1,000 leverage. With a $1,000 account. But now we're going to use a 5% risk management. Now, with a 5% risk management, that means this trader would be able to purchase approximately 0.50 lots. Which means they're gaining or losing $5 per pip. We're going to go ahead and use a 70% win ratio. So again, that means that they're winning 7 out of 10 of their trades. Now we're going to go ahead and use this 5%. Again, go with worst case scenario with the same 30 pips that they're willing to, every time they enter a trade, lose before closing their position out. So that 30 pips, if they were to lose their first 3 trades, that would amount to 90 pips total. Now that 90 pips, losing $5 per pip, would amount to $450. Now let's go ahead and assume that they win their next 7. They would make $1,050. Minus the $450 that they had taken in losses, taking that into account in their first 3 trades, they would be $600 in profit. Now that word right there that I just said is very, very, very important to understand, and that's profit. You can never lose if you're in profit. And if you're a new trader and you have a $1,000 account with 1 to 1,000 leverage, you again could have some room to lose trades. You know, winning 70% of your trades, if you understand technical analysis, how the market moves, market structure, things like that, 70% of your trades is very, very attainable as far as winning. So as you see here with 1 to 1,000 leverage with a $1,000 account using a 5% risk management strategy would allow you to trade a total of 0.50 lots. You're winning or losing $5 per pip. If you lose even your first 3 trades, it would amount to 90 pips total. You would have lost $450. That's okay because you could have chalked it up as a loss, figured out what you did wrong, moved on. You won your next 7 trades. Now you're $1,050 in profit off of those 7 trades. Minus your initial first 3 trades worth of losses totals you to $600 in profit. Now you have a total account size of $1,600. Now, using a 10% risk management trading strategy, in the first scenario, you'd have already had a blown account almost, with a total account size remaining of $100. You wouldn't even been able to continue your next 7 trades because you wouldn't really have had very much to play with. You know, you would have been in a fearful mindset because you just lost $900. But using a 5% risk management strategy, you can see here that you've made $600 in profit. You've won 70% of your trades. You lost 3 trades, which is okay. But the most important thing is right here. Your total account size balance is now $1,600. Something for you to understand is, as a trader in this market, you know, and having the skill set, we're in the business of compounding. Once you get greedy, and I'll give you a few scenarios that I've ran into. Once you get greedy, that's what kills your success. I remember when I first started trading, I abused leverage. I blew 4 accounts that were $1,000. I had lost $4,000 in the market. Now, the only reason I'm making this video right now and I'm still trading today is because of what happened with my very first experience in the market. I had no idea how to trade. I had no idea how to mark up charts. This was back at the beginning of almost middle of last year. And whenever I first started trading, the only thing I knew how to do, because I looked it up and Googled it, is I knew how to start up an account. I had my broker, I knew how to fund it, I got verified, and my first trading experience was with gold. Kind of ironic because I love trading gold now, but my first trading experience, this is how it happened. I didn't know what the London session was, the New York session. All I know is I typically stay up late. So I was up at about 2, 3 in the morning, and me and a good friend were looking at some trades, and we had noticed gold was rising. So we went ahead, he ended up doing it too, but I went ahead and placed 1 lot on that pair. I went to sleep, big no-no, I know now. Didn't happen in this case, but it has happened. Fell asleep. I woke back up at about 6 o'clock. Now, I'm in profit. I had taken that $1,000 account, and it showed me about $300-400 in profit. I couldn't believe it. You see blue pop up on that screen, and you are fired up and excited. I didn't even have enough time to go get coffee before I came back, and that same trade was up $900. Let me just put it this way. By the time the New York session opened, I was at $3,000 total in my account, and I had closed out that trade. I was fired up. I thought, wow, this is what I'm seeing in my news feed. And here's what happened. I got something called greedy. My next 15 trades I took were losing trades. I got to a point where after about my 8th losing trade, I was like, you know what? I think I should put in a buy because I think the market's going to go up. Actually, since I feel that way, I'm going to go ahead and put in a sell because, hell, I've been wrong the last 7 times, 8 times now. And every trade was a losing trade. And within 24 hours, I had $0 left in my account. Now, I had no idea what risk management was. I just knew that, with 1 to 1,000 leverage, I had $1,000 in my account. I had absolutely abused it. My next $1,000 account, I had, started trading with 1, 2 lots, 1.5 lots, things like that. And I blew that account. I went on to my 3rd account, blew it, 4th account, blew it. And finally, I had found my mentor through a series of events, family, friend, whatnot, but where I learned what I know now. And this right here is the absolute basis. This is what your trading revolves around. Understanding and properly implementing risk management into your trading strategy. Because I know a lot of traders right now that are posting on social media how, they're in profit every single day, they're in profit. Well, I have these same traders coming to me asking me, what I'm doing, how I'm doing it, etc. The point is, no, there is not one single successful trader I know that uses improper risk management and is successful today. Not one single trader. Every trader I know, even if they're a risky trader, they have enough in their account, meaning tens of thousands of dollars, to buy 1 lots, 5 lots, 10 lots, 30 lots. And don't get sidetracked and influenced by these things that you see. If you see traders out there trading with 4 lots and they only have to make 20 pips to make, a set of dollars, thousands of dollars, however much it be, don't get influenced by that. The only thing it's going to do is it's going to influence you to make a bad decision. Now, that we looked at a 5% risk management strategy, we see that your total account size is $1,600. This is duplicatable. You can compound this money. Now, most people think and believe that, they have to learn another strategy. If they're not winning trades, they have to learn another strategy. They have to learn a different style of trading. They have to join another group. They have to buy a scanner or, whatever it is, because they're just not making the right decisions. It has nothing to do with your trading strategy, and it has everything to do with understanding risk management. You see right here that even within 1 week, if you only took 10 trades, you won 7 and you lost 3. For that week, you're $600 in profit. Now, that's a minimum right there. The $450 lost total, say that you enter a trade, it went negative 30 pips and you just closed it out. Just close that trade out. The $450 isn't variable. This $600 in profit is variable. The only reason I put $600 in profit is because that's you winning 7 trades, making a minimum of 30 pips. Now, what I do is after I enter a trade and I make my 30 pips, I manually trail the trade from there. Meaning, if it goes up another 10 pips, I'll set my stop loss higher. Now I've went from 30 pips to 35 pips. And if it goes up another 10 pips, now I'll move that 35 to maybe 40 or 45. So this $600 in profit is very variable. Meaning you could have one trade go up 100 pips and win $500 in one trade. Make $500 in one trade. But with 1 to 1,000 leverage using 5% risk management, this is the number that I want you to take into consideration to use as a maximum. Here's some things that you have to do. One, I'm going to go ahead and write it out for you. You have to find your win-loss ratio. Two, you have to make your worst case scenario. So that you can find what your best risk management number is, whether that be 1% or 2%, 4%, or whether you push it to that 5% number. I use 30 pips. If I enter a trade and I lose 30 pips, I'll chalk it up as a loss. Maybe it was a bad entry on my part. Maybe the market did something that was just completely unexpected, but 30 pips is my number. You have to find your number. I wouldn't make it 40 pips, 50 pips, something high like that. Make it 20 to 30 pips. Try it out. Trading is it's a series of trial and error. So you have to find, based on your skills, your entry skills, your technical analysis skills, what that best number is for you. And every single time you enter a trade, you have to have a number in your head. You can't just say, based on my technical analysis, Euro USD is about to drop. You have to have a number in your head saying, based on my technical analysis, Euro USD is about to drop, and once I enter this trade, I'm willing to lose 30 pips, but I'm not going to get greedy. Once I make 30 pips, I'm going to manually trail that trade to where I'm nothing but in profit. So here's what I want you to do. I want you to find your win-loss ratio. The second thing I want you to do is make your worst case scenario. And the third thing I want you to do is find the best risk management percentage that suits your trading. For me, it's 5%. Sometimes I'll go higher, 7, even 10%. And the only reason is because I have the money to continue to fund my accounts. I'm a very risky trader. Someone like Quillen, who's very conservative, I don't really know what his number is. I don't know what some of these other traders' numbers are, but you need to find your best risk management percentage that suits your style of trading. If you're a conservative trader, you can't use a risky number. If you're a conservative type trader and you can't go in with a lot or 2 lots, and use a 10, 15% risk management. You just can't. But what I found is that if you're looking to duplicate your money, you're looking to compound your money, 1% to 5%, being on a scale of conservative to what the absolute most I would go if I was a new trader would be, 1% to 5%. That's the number that helps build a solid foundation as a trader. Because again, your strategy isn't going to be the basis of your trading success. Risk management will be. So I hope you found some value in this video. If you have any questions, feel free to post in our Facebook page. But this is Forex Risk Management 101. Thank you very much.